Good to see you all. Could I just remind you that our speaker would like to take any questions or counterpoints at the end, and for that you need, if you do want to speak, to mobilize these things by pressing the buttons, because otherwise the system doesn't pick you up. Our speaker is, I think, so well known that I don't want to spend a lot of time introducing him. Longer standing stalwarts may remember the roadmap, which he was, I think, rather his proprietary idea, but he's moved on and has fresh ideas and fresh services to offer. So without further ado, a very warm welcome to Robin Griffiths.
Good evening. I thought I'd begin by talking about all the things that we used to do when life was very different, and how in my career I've had to reinvent myself about 3 times, maybe 4. I've retired 4 times. I've reinvented myself. I'm in the 5th incarnation, basically, because I actually joined the City of London in 1966, and life was a little bit different back then. There were no TV screens. There were no Bloomberg or data stream screens. There were no Japanese cars, or very few, in the streets, and certainly none Korean. You had a piece of paper and a pen, and you created your own charts. And back then they would have been British charts. Back then investment generally was much less international than it is now. It really was. It still seemed pretty important and quite hard work, but it was a different world. They hadn't invented FTSE. It was the FT30 share index is what you were interested in. If you were very international, you might have known a bit about the Dow Jones as well, but mainly it was the FT30 and the stocks that were in it, and you were plotting them by hand yourself. I was very lucky in that I'd had a degree in economics from Nottingham, and when I was leaving that, my professor said, "And where are you going now?" And my answer was, "I haven't the slightest idea. I don't want to go back into industry," because I'd come from Lucas as an engineer. I didn't want to go back into that. He said, "Well, great, I've got a very good friend of mine who runs research at a firm of stockbrokers in London. They're called Phillips and Drew. And back in those days, we're talking 66, they probably had the best fundamental research in the City of London. They actually had a significant fraction of all the London actuaries in London working at Phillips and Drew. And I was very lucky in that my degree plus the subsidiary subjects that I had with it, accounting, statistics, company law, and all these sort of things, exempted me from, I think it was 9 of the 13 exams necessary to become an actuary. So merely by saying, "and I'll take the rest and become an actuary," you get into Phillips and Drew, because I never actually took the other exams because careers moved on. But that got me into the great team. And I did a training round, working for Mr. Joss Drew, so that was in the private client department. But I was really learning A and B and C. It wasn't my job. When I first got a proper job there, it was on the institutional equity trading desk. So I was a salesman, and all of the clients that I was allowed to talk to were institutions. Until I first retired 18 years ago, all of the clients were always institutional clients. So many of the things that technicians were doing with short-term trading strategies based on RSIs and moving average crossovers and all of that, I knew about them, but it wasn't what I had to do for my living, because the institution would just point, our size in dealing is so big, we're probably going to end up owning 10% of the company. I mean, the Pru more or less bought 10% of anything that it could get, basically. And it'll take months to get in, and if we needed to get out, months to do that. So all this short-term stuff isn't right. So I was always on the economic to macro side of it, even though I was looking at stocks in the UK market. And I stayed doing that, and I never really had any exposure to private clients until after I had retired from HSBC. Then it was, I was retired for 1 week, I think, before Rathbones phoned up and said, "You're coming to us." We've been a client for years. Somebody called Jonathan Ruffers leaving us to start his own business. Jolly good luck to him, but you could replace him with us. So I joined them, and they hired a young man called Rashpal Sohan to be my assistant. And I have to say, he's not here, he's in Cambridge, and commute from Cambridge is very expensive, so he likes to stay in his boffin's world in Cambridge. He's easily the brightest and most highly qualified young man, or even old man, that I've ever met. He's got 2 degrees so far. I'm sure he'll end up as a professor eventually. There's no question. His own elder brother is a professor and was taken from Cambridge. He's now in a US university. Maths is the subject, basically. Anyway, he was hired as my assistant. And when I got to the compulsory retirement age at Rathbones and thought I'm having to leave, they begged me not to take him with me. Of course, Cazenove said, well, you're coming to us, Robin, we know how old you are, don't worry about it. And I left Rashpal behind at Rathbones. He stayed another 7 years, and then he's finally left, and now we're back together again. And now the product up here on the board is the only product that I'm now doing. All the other consultancy things, I don't do them anymore. So the product I'm going to end up showing you what we're thinking and doing now is this one on here. And South Bank Research is the UK arm of the Agora Press. Many people know the name Bill Bonner. He's quite famous in his own right, writes a lot, does blogs and all of that, and own literally in America hundreds of newsletters. And over here in the UK, South Bank publish not hundreds, but a lot of newsletters. And the amazing connection comes from the Fleet Street newsletter. Because years ago, when I started my first newsletter, The Amateur Chartist, I hadn't been going for a few months, and the receptionist said, there's somebody called Nigel Ray just turned up to see you. I'd never heard of him. Anyway, it is the Nigel Ray of Saracens and all of that. He came in, he said, look, I publish newsletters. I write England's top-selling newsletter, which back then was the Fleet Street newsletter. You're a stockbroker. You just want to write yours. Let me do the rest for you. So we did, and it took off like a rocket. Of course, when Nigel Ray stopped writing the Fleet Street newsletter, it became moribund and just sort of redundant, sat on a shelf. And then when a good friend of mine, much more recently, retired from HSBC, went to the South Bank and said, I'd like to write you a newsletter. They said, oh, we've got this dead one on the shelf. We'll recreate it for you. Here is the file, the Fleet Street newsletter. And of course, he opened it up on the front page. Used to publish Robin Griffiths' Amateur Chartist. So he said, ah! And they said, do you know this guy? And he said, of course I know him. They said, get him in here, get him in. So I was taken in and showed them what I was then doing, which is all for institutions. And they just said, we love it, but it's too difficult for what we want. What we want, if you write one for us, we'd love it. So I'm going to end up at the end of the talk showing you what we're saying in the new product, which is going very well, and they're promoting it. There is a slight twist to these things. Normally when you write for the South Bank, they own the newsletter and they pay you a fee to write it for them. I didn't want to do that because I'm really doing it so that young Rashpal will get something when I finish, probably on a yacht somewhere. So we own the newsletter. But we share the revenues with them because they put a lot of effort into marketing it. It isn't cheap. Normally newsletters should sell for about £200 a year. Our one is £1,400. I've argued that they should lower it. They've done the sums and said, no, it's much better off where it is. Most of the people that read, they have money. They want to know what to do with it. They're going to be just fine. And it's going, they know their marketing, they do the thing. So I write this newsletter, Rashpal does the computing, and if you are interested in it, you can go to South Bank Research. Our product is called DITA, Dynamic Investment Trend Alert. And the editorial always sounds like me talking. I literally write it once a month, and then I forget it. Apart from the fact I do what it says, as I shall show you, I do what it says. and then everything else is done by Rashpal. So when somebody writes in, I've got a query on all this sort of thing, I don't have to bother with that. Rashpal is very good at answering all those sorts of questions. It is entirely based on technical analysis, but not the technical analysis we originally started doing back in the 60s. Do I alter the... Oh, I have to press a button here, don't I? So it's... that one there. Oh, there we are. Okay, so in the old days, this is what we started with. And with my first job at Phillips & Drew, you had to promise that you were going to become an actuary in the shortest possible time. You had to have read The Intelligent Investor. So all of those ratios that Benjamin Graham and others like that taught about, you had to know them. And your job was to use that, phoning clients every single day, in most cases 5 or 6 times a day to the same list of clients. I eventually had a list of 30 clients and just kept working around that. Eventually the names changed, because when somebody says, I'm retiring from this fund, I've got a new fund, you now get 2 clients, because you phone his assistant at the old firm and he's the new man at the new firm. So that's how your client list grows. But and of course you were talking fundamental analysis based on Phillips & Drew's fundamental products. And they had a ranking table of stocks, all in the UK market, in descending order of merit. And you were supposed to buy the stocks at the top because they were cheap and sell the stocks at the bottom. But when you were a salesman, you realized very quickly that you did a lot more business if the client was making money following your advice. And you did that by buying the stocks at the bottom instead of the stocks at the top. Because value investing doesn't actually work the way people tell you it works. There's no uniform level of value, and when something goes below it, it's a bargain, you buy it. If something's dirt cheap, it's because it isn't very good. And if something's expensive, it's because it's fantastically good and everybody else wants one. You go into a jewelry shop to buy a watch. You don't want the plastic one from Casio, although they do work fine. You want the Patek Philippe or the Rolex or one of those, because this is how value investing works. Incidentally, now that I've been 53 years in the industry, there have only been 3 occasions in my life when value investing has actually worked the way it did under Benjamin Graham's type rules. Even Warren Buffett had Charlie Munger to tell him, you're going to have to pay up or you won't be doing any dealing. So value investing ends up as being a style of investment management. It works when it works very well, and then it doesn't work all of the time. There are other styles that come into it. And at the bottom of the line is we've back-tested all of these styles. And there's one common thread that goes through all of them. And the common thread is the word trend. Doesn't matter what drives the trend, cheap or dear or innovation or all sorts of new things coming in, you will only make money if the price of the stock goes up whilst you own it. That is unalterable no matter what the rest of the waffle is that goes with it. We've had alpha, we've had beta, we've had all sorts of other things, but without an uptrend, you are not going to make money. We have back-tested this. In most of the books, there's something called What Works on Wall Street. In all of these books of what works, you'll find actual and relative strength trends right up near the top of the list. It works. So our work has descended entirely onto trends. In the old days, trying to pull this all together, it was very good. I noticed very early on that it made a huge difference when you started doing your trend from in terms of timing. And that's what pulled back in my economic theory. I realized that there were cycles in the data, and some of the cycles were instantly recognizable as what I'd learned at university, Schumpeter's model. There was certainly an annual seasonality, and then the 4-year, sometimes called presidential cycle, a 10-year cycle, and then a very long-term cycle, normally called the Kondratiev wave. There are some other cycles as well, and with computers these days you can easily extract these, but even back in the days without those that computer analysis, you could identify this. And I then had this brilliant idea that I know where the cycles are. I've got the economic data helping you to forecast at least the 4 and the 10-year part of the cycle. And if that's right, I can draw you a map of where we are in the stock market. And hence the roadmap came out of it. And it worked perfectly for years. But some things do intervene to change some of these cycles, or at least bend them out of shape. And that has happened. We used to be in what Bill Gross used to call normal. And when normal, the largest and safest asset class to buy was a government bond, and everything else was priced off that. Now we're in a period where the price of government bonds is delusional, to put it mildly, and has mispriced other things, so that you end up in equities instead of government bonds. So we're in a different normal, which I'll explain a little bit later. But in the old normal, when I was at HSBC, the roadmap worked almost perfectly all along. There are 1 or 2 things, like the 10-year cycle might be 9 years or it might be 11. You had to be in touch with the current data to keep exactly in tabs with where you are on it, with live feedback from fundamental inputs. But nonetheless, the roadmap that we published there was pretty useful. These are the cycles that we used to look at, and as in here, the lower one is annual seasonality, and most people know in words, sell in May and go away. And then there's a bit of a midsummer rally to a high. The worst part of the year is from August through to usually late October. And then you're in the strong part of the year, it's from late October through to at least May. We're in that period right now. That's the annual seasonality. You do need to detrend the data to show it up. So if you're in the middle of a roaring bull market, the seasonal fluctuations are all bent up to the right, and if you're in a bear market, they're all bent down to the left. But by detrending the data, which with modern computers is easy to do, seasonality is there. And all markets in the world have the same seasonal deviation, which is a northern hemisphere seasonal deviation. And the roadmap was based on putting those together with one extra shape as well, which was this one. I actually argued, this is before anyone had heard of Mr. Prechter, from first principles, that there was to be a special shape that would come out in a bull market and a different shape that would take place in a bear market. And I published this. The paper was called the Epsilon Factor, because the E leg here is the big one. And then when I go round, and especially when I was talking to an American institution, they said, "You've lettered your waves wrong." And I went, "They're my waves. I'll letter them how I like." And they said, "No, but that's an Elliott wave." Of course, at that stage, I hadn't heard of Elliott, so they explained it. So I then started to read books on Elliott wave. I now know Robert Prechter really very well. His eldest son, by the way, is called Elliott. I mean, he's into Elliott waves big time. And over here in England, there was an American guy, and both of us lived in the Barbican at the time, and I'd have dinner with him. He did actually have a little wife called Priscilla, I think it was, and Penelope. And when she died, which she did tragically, it took him down really rather big time, and he went down to Monte Carlo to live there. But he wrote a very good book on Elliott waves, just as good as a book as Prechter's books on Elliott waves. So according to my work, around a 4-year cycle, that is the fractal shape that you're supposed to get in a bull and a bear market. And I don't spend, unlike the Elliott wave people, I don't spend parts of my life trying to fit this cycle to the data, whether it's there or not. I expect that shape to take place unless something bends it out of shape. And occasionally you can find a factor that is bending it out of shape. The last 3 cycles we've recently been through have been stunted dwarfs of this. They're mini in height and have only been 3 years long. And what's doing the bending out of shape is quantitative easing. This is part of the new normal. But up at the top, back in the old days, was where in the cycle what was happening in the real economy to show where we were. And according to me, on this roadmap, we are in about here now. We're coming up to the final high, and there's going to be a bear market later. And I'll give you the timing of that in a minute. Now, the macro thing is about secular trends. These are the very, very long-term trends. If you really, with your pension pot, you don't want to wheel and deal. You want to put it somewhere that's really, really growing and let it grow. Many people are surprised by this. Since the year 2000, which if you can remember was a bubble peak, a rocket-like bubble peak, the dot-com bubble, the red line here is the American stock market. The green line is one of the best of Europe, which is the German stock market. My favorite is that one, which is India. And of course, with rather larger volatility than most people can live with, that's China. But I think you can get the message that we are living in a world now where what happens in the biggest countries of the planet in Asia is dramatically more important than what happens in the Western world. It is overwhelming and dramatically more important, and it's going to stay that way. Unless there's a nuclear war that suddenly alters where everybody lives. It is the dynamics of Asia which are the future from now onwards. I mean, I brought an exchange-traded fund on the Indian market before Mr. Modi was elected. I was put into it by Lord Desai of the LSE, who is very perceptive and follows this market. And he said the Indian market is ready if it has a leader with enough political clout to actually do something, because Manmohan Singh was bright but didn't have the clout. He was at school with Lord Desai, by the way. They would phone out each other up. And he said, I found the man. You haven't heard of him, but his name is Modi. And when he wins, and he is going to win, it's going to take off like a rocket. My average price is between 14 and 15,000 on the index, which is over 40,000 now. So just owning an exchange-traded fund that owns that market, that's what secular investing is all about. Now, there are moments, because of the volatility in it, when it's coming down like one of these, or one of these, or one of these, when I top slice the holding, and I have topped my holding now. It's still relatively large, but it's much smaller than it was. But I'm still expecting the long-term trend to do this. Desai says don't stop until it's at least 100,000, so we're going to more than double again. But it could nonetheless fall back 15 to 20% in the meanwhile, and I don't need to own it while it does that. So that's trading against the secular background. And again, most people don't think like this, but when you really adjust global data for inflation, this is what you actually get. This is the world index going up and down, and you can do your W, X, Y, Z and ABC shapes on here. But adjusted for inflation, it hasn't been a wonderful decade we've just had. Lots of people haven't made any money. The ones that weren't in China and India, they're struggling to get back some of the money that they invested. So again, in the newsletter, we don't usually publish this, but we've got the economic data, and I look at it in helping to understand these secular trends. This is another much more complicated, and there are more cycles. Each of the cycles put up here, there's books written about each cycle. It's not my job to do all of that, although I do use some of it. The important thing is, in any situation where there are many interrelated cycles, it will inevitably have a moment when they all go up together, and there will inevitably be a moment when they all come down together. And there's one of them there, and there's one of them here. There's a whole bunch of cycles coming down to a low round about here. We haven't got to the low yet, but when they all come down together. And it's only after that that a whole bunch of them take off together. So that's part of the strategic thinking. I'll try and fine-tune it a little bit in just a second. But none of these cycles are purely they're economic. You can follow them on charts using technical analysis, but knowing that you've got interrelated cycles that become phase-locked. I don't know if you've ever seen scientists do this. They have a whole series of pendulums, and you bonk them all at random, and they're all swinging in different, and you walk away, half an hour later, they're all lockstep together. So cycles, when they're powerful, do tend to lockstep together. And when they lockstep for a down wave, as we found out in 208 recently, you get a down wave. I can still tell you the most frightening down wave in my life was 72 to 75. That really was much more frightening than anything we've seen since. But we might be getting something like that in our future as we go from the new normal back to something more sustainable as a different normal. Now, demographics. When I was I was a partner at Griffiths and Grant, they sent me to live out in Japan. I spent roughly 10 years of my life going backwards and forwards to Japan with institutions, going around all the things. I literally had the privilege, we would phone all the companies up and say, with us we're bringing 10 institutional fund managers, some American, some Britain, and between them they manage X trillion dollars. We'd like to meet the right people. So I have actually met and shaken hands with the Toyotas of Toyota. I've met Papa Honda, he's dead now. Inamori, I've actually met these people and seen their business and seen the passion that they put into making them grow. When I arrived in Tokyo, this was my first day in the office. I go in, they give me a desk and a screen and all that sort of thing, and I read the Nikkei. There's nothing to do yet, I haven't got time to talk to the boss yet. I'm reading the Nikkei, and there's the first article by Barton M. Biggs. And in those days, when Barton was writing, you had to read Barton Biggs. I mean, all over the world, he was a very readable man. And he said, sell Tokyo, maximum risk, 7,000 for the Nikkei. So when I do get to see the boss, he took me to lunch, and I said, why have you got me out here? And then Barton is saying that. He said, don't worry about Barton. We all love him, but he's often wrong. So I learned that. The great men can spectacularly be wrong, because it was on its way to not quite 40,000. And then right at the top in 1989, I was called back to London, and there's not really been a reason to go to Japan ever since, basically. So Barton in the end was right, because it came back to 7,000. But he missed out on quite a bull market. And again, that bull market also persuaded me that valuation wasn't something you necessarily needed to take terribly seriously, because the largest stock in the market right near the end was brought to the market on 300 times earnings. Nomura got the stock away, and by the end of the week it was up 10%. So the market did its job. You didn't want to carry on holding the stock after that because it came down again. So value was, and then more recently, we've learned the other way. In the American market, you're talking about value. What you shouldn't have done was buy Procter & Gamble or Walmart on 12 to 15 times earnings. You should have bought Tesla on no earnings, or any of the other FANG stocks on 800 times earnings, because they're going to treble. So it isn't about value some of the time. It's about the trend. And when the trend is there, that is what you're backing. Now, the important thing, these illustrations come from Harry S. Dent's book. Demographics work in a certain way. It doesn't matter what country you're born in. When you get to certain ages, you do certain things. You get married 21 or 22, you build your first little starter home, then later she's pregnant, you have to move to a bigger home, and then later she's even more pregnant, you need an even bigger home and 2 cars, and your expenditure peaks round about 46 to 50. You've got your biggest house, the most kids, they're all at school, and after that you can get rid of some of the things the children are going to leave you. And this was Bain & Co. was the biggest client in Chicago. And Mitt Romney owns it and ran the thing. It's his company. And this guy worked for him and was printed out charts, had charts all over his desk, and he picked up one and what's that? What do they look? Well, they're sort of same, and he sort of put them together. Oh my God, they fit. And then he realized you have to move it along 46 years. So if you take the birth rate, move it along to the peak expenditure, it predicts the stock market. And this was when the baby boom generation peaked. Then you come down as our children work. There will be a subsequent boom when the millennial generation start driving it. If you were born at the millennium, you're out there, you're going to have a great career, but meanwhile you're at university and you owe $100,000, so you're not ready to drive any economy yet. It's when you get employed by Goldman Sachs and now you can pay off the loan and now you start driving the economy, there will be a boom. But it won't be as big as the one caused by the baby boomers. So the more you read about Western demographics, you will realize that the great boom was caused by our generation coming after World War II and driving the thing up. Our children were the missing generation. I've got 4 boys all trapped in there. And it's the next generation, the millennials, that will drive the next boom with newer technologies coming along. This detachment that you've got is entirely because of QE and pumping things up, driving interest rates to levels which have never been before in history. It's a completely unprecedented new normal, mispricing what used to be the safest asset. Now, this low, I put here 2020 to 2023. If you would, I was giving this talk, let's say, a year ago, I would have said from roughly now onwards, we would roll into the bear market. And then roughly 2023 onwards, we'd be ready for the next bull market. All that's happened recently in the new normal with quantitative easing coming along is that they've bunched it so that this year is not, firstly, we're in the strong season up until May anyway. Secondly, this is a presidential election year. And you watch the TV same as I do. If the cleverest thing the other lot can do is to have a farcical impeachment thing that was never going to win anything, and her most defiant gesture is to tear up that's it. That's running for being president. They've demonstrated they haven't got anyone who could run for president if his life depended on it. And unless Mr. Bloomberg really does decide to do something, I don't think they've got a chance. You're going to get more Donald. But once Donald is back, now he's in the lame duck period. He can't run again after that. I think you're quite likely to get a blow-off high into the second section. So what might have been 2020 gets to be 21. So 21-2 ending in 23 is looking from a lot of cycles' point of view as we could call it a bear market. If it's a grand super cycle correction, well, then it will be a big bear market, minimum 50%, usually more than that. I mean, I don't know if you know about bear markets, but they'll be a quarter, a third, or a half. Incredibly few ever fall more than 50%. And the ones that do go straight into the history books. So if you're trying to get the grand super cycle back to the old normal world we understood, it would go in that period of time. Having said that, Mr. Prechter, who is a good friend of mine, has been trying to call this for the last 20 years. And when you're trying to remove the fifth wave on and on and on, eventually even your own staff, they just don't want to talk about it. So it's jolly difficult to call this, but all I can tell you is the various cycles that bunch together all are suggesting we might get through to the end of this year. There may even be a brief honeymoon at the end of it. Normally a new president or a re-elected president gets a bit of a honeymoon. But if we then begin from very bad value levels, it's 21 to and into 23 looks like being a nasty bear market. Incidentally, I've already mentioned China, and this is the G4 contribution to growth. This is the Asian markets coming up. We've got the crossover. From now on, the red line's going to be up here, the black line will be down here. So the Western world is no longer in the driving seat. Nobody's going to challenge America's military position for a long time. But demographically, they haven't got a leg to stand on. So there's no point in stimulating retiring baby boomers who are getting rid of spare properties. If you were the next generation American, in many cities, there will be 3 or 4 apartments that you could go and live in. Here in London, we don't have this problem, and in Dublin, they have even less of a problem. But in America, the next generation will find there are 4 or 5 properties for me, and Dad may even give me the money to lend in one. So that market's not going to work. And there's no sign of the next economic boom coming just yet, basically. So it's all about Asia, Asia, Asia in the secular uptrend part. And of course, the Indian part of that has very good demographics. One of the best books to read is called Factfulness. You can get it in Waterstones or something like this. Very good professor, and he's on YouTube as well, explaining that the big title is called Factfulness, and in little writing underneath it says why most people are too bearish about the world's problems and get it wrong. According to him, the peak baby on this planet has already occurred. And because of modern medicine, you in the countries where you used to have 10 children each because most of them would die too young, they're not all going to die. So they stay, the pyramid goes from being pyramid to parallel-sided. As that happens, the total world population will build up to about 10 billion. But even though the birth rate for the planet has long peaked already, it's the fact that we live longer that's changed that. And even this guy used to work in Africa in lots of poor places where you knew they had 7 to 10 children each. It's about 2, maybe 3, but I mean it's come way, way down. And there's other facts of this type to be worth reading in Factfulness. Very good book. This is an old slide, but just to point out that technology used to drive great big booms. And along here, this is, printing press, telescope, steam engine, telegraph, car, man on the moon. We're now way up here where you don't wait 50 years for each new technology to come. We're going to get, in the coming next boom, lots of new technologies. We know from the media we're all poisoning the planet. A lot more things will go electric. There's going to be new ways of making electricity. I'm on my 5th hybrid car, but Toyota is the biggest maker. They are very big into hydrogen. You only got to put water into it, crack it into oxygen and hydrogen. That drives, as long as you make your electricity in a clean way, the problem will go away. And you can do that much quicker than putting in charging points for everybody for battery-powered cars. So there will be battery-powered cars, but also hydrogen coming. There will also be here more medical stuff coming in. I was going to say that even without the current panic about the virus. And robotics also coming in. So the technologies that would help the next boom when the millennials are old enough to be in the right place to be the driving force, there's a lot of new technology there with new companies coming along that will drive this. Now, in the old days, this various universes, we still do this, institutions want it. I've run 2 hedge funds in my time on this universe, the world's biggest 500 stocks by market cap. That way no one says you can deal in them. If you can't deal in the world's biggest 500 stocks, you can't deal. So, and all we do is we divide them into uptrends and downtrends, and you're only allowed to buy the top 10% of the list. That's what the time I ran it, that was that. This is the S&P down, this is the top of the FT 350, this is the European one. We do this for lots of markets, but it isn't the basis of the current work. This is more what we used to do, and people would leap about between the weak stock and these strong stocks. But increasingly, that is not what's happening. More and more investment is going passive. because more and more investors find they don't beat the index. I think in this country it was the Coal Board and the Legal and General realized they had a big dealing room, they had all their own analysts, they were getting brokers analysts, they wheeled and they dealed, and they end up underperforming the index. And the boss said, he was called the Welsh Wizard, just fire the lot, buy the index. For less money, I've done a better performance. And these days, we're very nearly 50% of institutional money is now passive. And the amount moving passively is getting more and more. And this leads into directly what our work is now doing in the newsletter. This is based on the newsletter. We rank them in different currencies. So this is the American, British, European, and Japanese. We do it on other markets as well. What we've got here is we take for every asset class, there are exchange-traded funds. So we've spent quite a lot of time going down the list of ETFs, because some ETFs don't actually do what they say on the tin. So you've got to make sure this ETF, if I buy it to equal the American market, it will equal the American market. If I want one called the World Equity Index, that's what it will deliver. I want something else to be gold. Well, GLD just about does do gold, but plenty of other ETFs say they'll do gold, but they slip. They never slip the right way. They always slip against you. So basically, we've got about 40 ETFs. Between them, monitoring just them, you can switch your money between all asset classes globally now. And in the case we're now thinking in dollars, so dollar is your thing, the top quintile gives you that line. This line is the index, just passively holding the index. This is the next quintile and the bottom two quintiles. So your bottom quintile since 1998, your 100 has gone down to 71. If you were owning, they were in the index, you're only ever owning index stocks, but you had the wrong ones, you were losing money. And in most cases in Europe, your 100 has gone to 67. In Britain, you're just about, you've broken even 104. And in Japan, it was 63. So this is the bottom. Now, the reason why we've got quintiles, not just up, down, and sideways, and originally we started with up, down, and sideways, we realized by dealing in them, if you only buy the uptrends, some of the uptrends are stronger than others. And when the uptrend isn't very strong, there's quite a high probability you back it, and the next week it breaks down and you've lost money. So you want to have no probability of dealing in a stock that's too close to coming out of uptrend. So you have to have very strong up, neutral, down, very strong down. You end up with 5. And basically, we've actually also back-tested only being long the top quintile and short the bottom quintile. Actually, we've proved that makes less money than only being long the top quintile. And the clever thing we've done in our list is, in our list of stocks, we've put some bear market assets. So one of the asset classes is cash. Another is inverse equities. There's an inverse FTSE ETF. We've also got gold in there. And what happens is when they come to the top of the list, you didn't need to predict it was in a bear market. Your system says this is what you're buying. That other stuff you used to be bullish about, it's gone down the list. We don't even, in the old-fashioned way with charts, you're long of a stock, and for it to roll over, turn down and give a sell signal, you had to give up part of the profit you already had in the bank. There's nothing, I tried lots of systems to do this. You could have a trailing stop or a different moving average, all sorts of things that we all know about. But you're going to give up a bit before you are allowed to sell. On this system, you don't need a stop loss. In the system, bear market assets rise to the top, you buy them. You didn't let your bull market asset go down. It simply got overtaken by something rising quicker. You always buy what's rising quicker. There is one bit that is a stop, which is how much momentum do you need for it to be enough momentum? And we've back-tested this a lot, and the answer is a half of 1% a week. So if you held it for a year, you don't usually hold it for a year, but if you were going to make 25% per annum holding that stock or ETF. Now, in fact, you almost never own anything for a year. You frequently own everything for at least 3 months. So 3 to 6 months is where most of your activity is. So each month when I'm writing the newsletter, this happened to me the last 3 months. Ever since late October, our system said go risk on, fully risk on. I wrote that October, November, and up till I've just sent out the last one. So all that's happened is more equities are coming up the list at the moment. And by the time we get to be selling, I will find things at the bottom of the list, cash, bonds, and inversing equities. They will have come up the list. But it didn't need a stop loss on what we're holding now. Now, I must point out, here we are in America, when the green line comes down like that, or this, or even these little ones, you will be thinking to yourself, I've done what Robin told me to do, and it's not bloody working. It's all gone wrong. And even here in Britain, these little wobbles here, or even that one, it can hurt quite a bit. But you're still on that line, you're not on these lines down here. And this black line is passive holding the index. So you're thrashing the index. You are a bit more active. There are certainly times when it thinks it's a little bit wrong. And there's nothing I can do about that. That's how markets are. However, you can see that in Japan, our top quintile still has won. But look what a rough ride it's given you. So this is the only market that's as bad as Japan. It still makes you money in Japan. You go from 100 to 660, whereas up there we're to 1,400. Incidentally, we have back-tested our system absolutely ruthlessly since 1998, and there's only been 1 year when it lost money. The loss that year was 6%. Now, most people say, oh, that would be 208. Or something like that, really bad. It wasn't. In 2008, we made good money because our system took us out of equities and made us go short and into long of gold and all that sort of thing. No, the year was 210, and we lost 6%. People think, whatever happened in 210? I can't think, nothing much happened in 210. That was the problem. There were several strong moves that our algorithms said were trends, but they didn't last long enough. It was a volatile year when nothing much was happening. And there, the volatility was big enough and the trends short enough, you were buying and selling and buying and selling, and the accumulated expenses, you lost 6%. In the roaring good years, and there have been 4 of them, the whole portfolio is up 40%. It's done that several times. But the better number to remember, what this does for you, your money compounds after all expenses at just over 15% per annum. Now, we've deliberately played with the algorithms to not make it, shoot the lights out. We're not trying to beat a rising market. We're trying to not lose when it comes off. And there are several fund managers that do this, and I mean, Ruffer was one of them. The trick is, when the market is going up, showing enough momentum of 0.5% per week, why do you want to beat it? Just own the damn thing. That's what you're trying to do. When it's coming off, you don't need to own it. So that as long as you're in those strong markets in each portfolio, you can expect to average 15% per annum. And in a good year, you might make 40%. There's never been a time when you've got 2 consecutive 40%. That hasn't happened, but there have been several 40%, and then a few much more modest numbers, and 1 loss in all of that run of history. But you will worry about yourself when you're going through these sorts of periods, but you do have to just know that you've got a system, you know it's got an edge, you stick in there with it, and it comes out well in the long run. Now, this is how the portfolios look in the newsletter, and we always keep the color coding constant. So the yellow bar is the global equity index. And the reasoning is this: if you can't beat the global equity index by doing something else, you're taking more risk than you should to underperform. So you shouldn't do that. So basically, when world index is up there, you got to be long the world index. You can see that at the moment, the US index is up there, but you can also see gold is up there. This is in different currencies, but even in dollars, gold is up there. Now, these changes are quite recent. One of the things I need to show you is red is always India. India is much more volatile. For month after month, India was the top of the list, by far the top of the list. Now it's wobbling. I'm going to get one of these pullbacks. This is why I've top sliced the holding out of it. China is also massively volatile. It had been down here prior to recently. Now it's come back up again. The other thing to notice is the bottom quintile. This pale blue color is cash. The black one is inverse equities. And there's some metals, global commodities. So it's telling you what you don't want to own. You do not want cash. You do not want to be short. You do not want to be in commodities, except gold. Gold is not performing like a commodity. It's money in this new normal. And as we move into a more dominated period of Asia, in both Chinese and Indian culture, gold is the only real money and has been forever. It's going to be more so in the future. So gold is performing very well. Incidentally, I am a member of an investment club. It's really a gentleman's posh eating and drinking association, but it does have a portfolio. And I'm only telling you because this last 12 months, I've just won the prize. My stock was silver wheaten, it was up 55%. However, the portfolio for the whole club was down about 5%. And I've noticed this with small stock portfolios. You will always have some winners, but the losers, cancel them out. You'll only remember the winners. So I'll remember silver wheaten, and we'll forget the other rubbish that lost all the money. And that's how it normally is with these things. I remember in this society, Anthony Bolton has come and talked to us over many years, as you know. And he beat FTSE by never owning a stock that was big enough to be in FTSE. He did break the rule just once, and it was one of his biggest losses in his entire career because it was Polypack. And our system says you will only ever own a stock that is in the index, but you only own the best of them. So it's timing on the stocks in the index. So even in my list of stocks, if it's not in the index, I don't even look at it. I've never looked at the chart of these small, hot ideas. But for a dinner club thing, oh, well, silver wheaten, I can pop that in, because you need something that's ludicrously volatile and very big beta and all of that to win those sorts of clubs. It's a stock I've used over many years. Now, in our system, the more people use the system, they get used to the color coding. You can see, where's Britain? There, this color blue is Britain. And at the moment we've come up. I mean, especially since the election, basically, we've come on up. We were down here before. So it's gone totally equities on. But ever since the end of October, it was global equities that moved up first, led by America. And now other markets are now catching up. So this is a totally global equity buy, and avoid all the negative stuff. But if we're right, as we go through the year, we get Donald elected or a battle for it, slowly these things will start coming up the list. And some of these will drop back down. And when they do drop back down like they do, we come out and follow it. Now, we back tested. The rule is you only want to own the top sector. But several people have said to me, that's a very compact portfolio, Robin. Can't I have a few more holdings? So Rashpal has back-tested if you hold the top 2 sectors, but no lower than that. And what actually happens is you make slightly less money, but you have spread your risks wider. So the risk-adjusted return is slightly better. You've chosen to make slightly less money, but you're going to get a smoother equity curve. The other situation that we've found when we will get caught is, it's only happened once in our life, was 1987. You're in the middle of a bull market that goes all the way through to 2000, and you come in one morning and everything's down 22%. If we get a crash like 1987 crash, our markets will come off. They'll be the strong markets, so they won't come off the whole amount. But if there is that type of crash, we're in there. But if it rolls, as it did at the end of 2007, from a roaring bull into a bear that then gets nasty, our system changes quite quickly enough for us not to anticipate a signal. As the thing changes, it took us out of the equities, put us into shorting, put us into gold, cash, etc. And we took profits at the end of 2007 and ended up making money. I mean, we were up 6% at the end of 2008, when, as you know, the market was down 50%. So you can't go up hundreds when the market's crashing, but the system worked very well. And in looking back, have there ever been a chance to anticipate the change in the signals? And unless you know there's an 87 crash coming, it's not worth anticipating the signals. We've tweaked the algorithms over the years so that they respond quickly enough. Because if you tweak them too much, you turn up being a day trader, and that's not what we want. This is for people's main core portfolio, their pension pot, their main assets should be following a system along these lines. The red line is gold, and it's going up again here. The purple line is Berkshire Hathaway. The black one here, this is the S&P, and this is Treasuries. So I'm showing this, but I'm not a gold bug, but I do like gold. And the work is showing that it's beating something. I mean, Buffett hasn't been doing too badly, but it's been beating him all along. And when it beats him by a lot, it beats him by a lot. And I think if we take this high out, which is very likely technically to me, I think it is a prediction, it's going to fly. And that gap between the red and the purple will get bigger again. In the model, GLD is the only thing we've got. So if you want to say, well, I want a stock, what about Barrick, or what about Newmont, or all of that? You know, we go into the stock list to do that. But in the newsletter, this is what we're saying. Now, here's another thing that we do. This is month after month after month after month, the list. So up until October, the yellow was down here, and so was America. It was quite a dull summer. I wouldn't say it was a very bearish summer, it was a dull. But ever since October on, led by America, world equities, but gold. Isn't that interesting? You've got a bearish asset up there when all the other bearish assets, cash and all that, are down the bottom. Just telling you gold is not behaving like a commodity. It's money. It's in the new norm. We've got to have gold. And notice that the volatility in India, which up until then had been way up here, dropped way down, and then it's volatile, it springs around. But you can see how volatile the Indian market relative to the others can be, and the green one, China, can also be more volatile. They are more volatile, you've just got to accept that. So you'll be trading in them more often, whereas the other markets are much less volatile. But at the moment, you've got to own some American equities, the world equities, and even some of these. That's long gilts, you're allowed some of them, although they've dropped back now. So it's gone more total equity than it was back here. And this is the rate at which you can see it change month after month as the newsletters come along. So you can see that you were waiting, and in October you were told to buy equities, and then any slight change you've been told, okay, take the top off your India, and otherwise, here gold is this is in pounds. We've slipped back a little bit, and our UK market is up there. So you can see the changes coming along, and they're often enough, but without making you a frantic trader. This is the grand summary of all the markets that we follow. On this side, the whole table's done in local currency. On this side, they're based into a common currency in this case dollars. This is ranked in the shortest term trend. This is ranked in the cyclical one. This is our composite weighting of what you might call the big picture answer. So the big picture answer, China and India are up there. World is neutral. On this scale of things, world is almost bound to be neutral because we're looking at the world from a long-term point of view. So the world index is supposed to be in the middle, basically. This is the UK. Incidentally, over all of the years since 1998, our methodology has never put more than a quarter of the money into the UK stock market. Because even when we're doing quite well, other markets are doing better. So just picking between our 40 ETFs, why go just because we're British, we've got to own Britain? It's rubbish. We go to the market that's making us the most money. So for all that time, we've never had a lot of money in the UK market. But you can see why long term I like India, but in the short term, the Indian market can drop like that, which is what it's doing now. But long term, India is my favorite long term market. Germany is still up here. And then quite a lot of stuff is down here. These do change. And of course, when they do change, we write about them in the newsletter. And then the people that can do it all in local currencies can deal off that table. But really, for me, this table here is the short, the medium, and the long-term view, market by market. If you had to do a sort of stab, I'm going to own it for a while, a long while, I would use this column here, basically. This is the table that we actually put into the newsletter. Each of these are different months going forward. And the colors work like the traffic lights. If it's green, it's go. If it's bright red, it's stop. If it's amber, it's kind of wait. And if it's blue, it's a bit neutral. So at the moment, these are the top stocks that we're telling you to buy. I need to point out this equity one there and that one there. Once we started to do this, several people said, I want equities, but I don't want to be trapped into a country. There are two very good ETFs made to manage high-quality stocks. And the number of boxes the stock has to tick to be deemed to be high quality. It must never have cut the dividend, it must have grown, it's got to have been in existence for at least 10 years. All these, by the time you've qualified to be on the list, they're superb stocks. There's also the low volatility ones. They also have to perform in a low volatile way. And at the moment, you need to have quality. Quality is outperforming. And also inverse equities, commodities, gilts, cash. Those are the things you definitely don't want, and you do want to be up here. There's gold at the moment. This is in sterling. In different currencies, gold is still in the top box. So basically keeping you so that you'll follow a little bit. These two boxes are where you should be looking all the time. And these are the current recommendations. And on the back of the page, we've got ETFs that represent them with low dealing expenses. And they're all, the expenses of trading in these things are all allowed in the model. I think that's probably the... At the moment, this is why the downswing is probably unlikely to take place just now. You're not allowed to call it QE, we know that. Okay, it's not called QE4, but it is. And all central banks, this is now part of the new normal. Central banks talk to each other on the phone and act in concert with each other. If the markets look like they're going to have much of a downswing, you can have 5, 6, 7. Mr. Greenspan spoke up or wrote an article not long ago saying, I invented this game. It didn't go wrong on my watch or on Bernanke's or on Janet's, and they've got lots and lots of practice. So part of the new normal is the balance sheet at central banks is what helps drive the growth. And when you're running up to a presidential election and Donald taps you on the shoulder if you make a mistake, it's not going to happen until he's back in power again, basically. So that's part number one, QE. This is the black line is the world market. The blue line is America. America has shot away, pulling the index up, and now even the lagging markets are starting to break out and follow. That's where we are. You can see it on the chart. So the red markets look as though, some of them anyway, will break this high. But the lead was the surge in the American market. And as I say, that's how it looks as though it's going to stay. This is the QE. Now, we thought back at the end of 2008, central banks' balance sheets were pretty stretched. That's what they were borrowing there. There have been 800 rate cuts, and we're up here now. Here is the QE. You're not allowed to call that QE4, but that's what it is. So it's not going to go down just yet. You would need a war and a virus and all sorts of other things, but that money is going to go into the market. Now, this is very interesting. This is one of those charts that rotates around the zero. And so the really fast-growing ones are here. These are slowing down. These were contracting but moving up into recovering. There are 28 markets in here. Most of the ones we're interested in are in this little group in here. And they do look as though they're moving up here. There's China there. This is India. UK is right on the zero, just crossing into the positive recovering. But you've got 28 here and 5 up there, none here. Now, when we get to the end of the year, I think these will all be up here, and then they'll be ready to drop down into there for the big correction. But that's a prediction. All we do is follow what is happening. Our system does not require us to make predictions. For most of my career, I had to, the clients, make predictions. But this system is designed so you don't need to make predictions. You follow what is the strongest trends now. This is different markets, 1, 3, and 5 years, the percentage of total clients that fail to match their benchmark. These are active fund managers. So in a nutshell, no big institutional fund manager beats his market, no matter how hard he tries. Now, we all know, I know some of these guys for 40-odd years. When they're brilliant, they're brilliant. And easily, I remember at the bottom in 2008, I got the low pretty sharp for a rally from a low. But one man in Mayfair said, this is the low, and what's going to happen is a monster bull. That was Quentin. And he had doubled his money on Barclays Bank before most other people accepted there's a bit of a low here, we can start to do some buying. But since that brilliant time, he has had 4 consecutive really bad years. And when you're talking to the firms that manage large private client money, they don't want the equity curve that Quentin's going to give you. They've got money. They were born with money and they've got more money. They go to someone like Cazenove to say, don't lose me my money. If you beat an index, make me more. Jolly well done. That's why I'm paying you your fee, but so shut up. But well done. But if you lose the money, you can be fired. You can be fired straight away. You're not there to lose money. So if 1 minute you're with Quentin, you're up 40%, and the very next you're down 30, and then 3 more years later you'll lose, they just take the money away. Many of these big, very famous names in the hedge fund market, they end up managing their own money because it's less expensive and the clients can't stand the rough ride. Our whole system is designed not to have the rough ride. And of course we will underperform when they're brilliant. But we're there year after year after year at a very acceptable rate. So that's the basis of what we're writing now. These are real figures. The green, this is passive money in the equity markets. This is active money in equity markets. And this is passive in bonds and active in bonds. So obviously the less volatility in the bonds. But that trend is coming up to here. We're within about a year of the overtake of passive money being bigger than the active money. So the active money, the really active money, is for small people using it like, instead of betting on the Grand National, what was the stock? We'll buy some of Tesla. That's what it's for. It's not really handling the big pot of money. This trend, I think, is going to keep going. This is one more thing, though, because I mentioned value investing. The magic number for value is 7. When the dividend yield and the P ratio is 7, you're allowed to buy. And in the bottom of, after the 72 bear market, the first 2 stocks to bottom were Shell and Thorn. And in both cases, the dividend and the P were both 7. That's the net number. Now, fairly recently, people said Legal & General 7. And quite a lot of value investing was done, but it hasn't worked yet. What you want is quality stocks, even if they're more expensive. You don't want the value ones, because there's a reason why they're driven down yet. Now, in the end, if you buy quality stocks that will survive on those low numbers, you will make money. But at the moment, the system is saying, no, you stick to quality now. We'll go for the volume value later when that black line turns up again, and it hasn't done so yet. So at the moment, our model is against what has been quite a big trend in some institutional markets. Yes, I think this is the last slide. When will the market go into recession? Now, a year ago, these boxes here were up in 2020. This was up at 25%, something like that. As of now, though, black line is Goldman Sachs' forecast, the red line is Wall Street Journal. The probability of your recession, 21-2 into 23, is really very, very high. All that's happened is that one's shrunk down because of where we are on our shorter term cycles, driven by QE4 and these other factors. Once you're through the correction, there's very low likelihood, and this is when the millennial generation become old enough and are starting to drive the economy with the new electric cars and all these other technologies to back. So we could get a bull market from about 24 onwards, and again our roadmap will go 1, 2, 3, 4, 5 from this sort of level. But the full rally rest of full shape in here is very likely. Obviously, not all markets move exactly together, but we're living in more of a joined-up world than ever before. And likely, when we're here, I think my work will be saying, and you want even more in Asia now than you do at the moment. Because that trend towards Asia is just going to keep going on and on. So I think that is the last slide. Yes, if anyone wants any questions, I'm delighted to answer.
Robin, thank you so much. Delivered as tour de force as his hallmark, and also with panache as the hallmark too. So let's have some questions. Anybody? Yes, can you use the...
Hi, Robin. What are your favorite trend technical indicators?
Regression analysis. You could build a model like ours using moving averages and things like that. But I've always used regression analysis.
What do you mean by regression analysis?
Well, this is what got me into that. Way back when I was publishing the Amateur Chartist, and I published the index, and my trend line went down the middle of the data with 2 parallel lines either side of the regression line, 1 and 2 standard deviations. Very quickly, somebody called Alec Ellinger phoned me up and said, I, from the ACTA, as this society was called, want you to come and talk to us, because we get a ruler out and we connect all the highs, all the lows. Your line down the middle is really clever. Come and tell us how you do it. 'Cause this is what got me into being a technical analyst. I was just using regression analysis, which in my degree was a good way of handling data, basically. So, of course, in the model, the actual numbers we're using are a secret. But you could play around with a computer and get there, or even using moving averages. What you want to know is this a trend, and is it rising fast enough to have enough momentum to back? And the second secret of our thing is to have bear market assets in the list with the good so that you don't need a stop loss. Yes.
No.
Hello there. You said you use a cutoff for trends of 0.5% a week.
Yeah.
Have you always used the same measure both for, say, Japan and Europe?
Yeah, if there's enough momentum to make you 25% of a year's run, that's enough. The probability of it suddenly going wrong just after you've backed it is actually quite low. You may sell it 2 or 3 weeks later, but the chance of it going wrong tomorrow is very low. Whereas when the trend is less than that, it's like a minefield, basically.
Jeff.
Hi, Robin. Thanks for your talk. Just a quick one. I think I know the answer anyway, but it seems like it's a monthly rebalancing.
It's a monthly newsletter, yeah.
And do you rebalance the
Yes.
portfolio? Is it literally at the last day of the month?
Yeah. Yeah.
Okay.
Hi there. I have a question about what you said about value. If something is expensive, everybody wants it and they want to buy it. If it's cheap, it's not very good quality and people don't want to buy it. But a lot of the time in the markets, value is about perception. So something may not actually really be worth that much or may be worth a lot more, but it's more how people see it.
Yeah.
So
Like Tesla, for example.
Sorry?
Like Tesla recently.
Okay.
Yeah.
So what would you say? I mean, like I do currencies mostly, and very very often I see currencies rising when I know that country is in a bad state. You know, so really it's the perception that's pushing it up, but it's not really worth that amount.
No, I just in my method we have to look at all of the assets in the world. So for you trading your currencies, I think you should stick with what you're doing. But the point about value is, in my 53 years, there have been 3 sets of times when value seemed to be the numbers that were working. The whole of the rest of the time, it was different. So, and actually you've got a different slide showing when the different styles come up, but that isn't in the newsletter, that's just for institutions, so I didn't show it today. But what is not changing is the trend. When the trend is strong enough, is when you need to back it. And it has to be enough strength to have very low chance of going wrong on you.
What's the name of the investment club that you mentioned?
Yes. Well, it's 12 of us. We meet in very nice places like Boodles or the Turf Club, and we have very splendid meals and drink a fair amount. And there is a portfolio, and it loses money. But,
Robin, in terms of measuring the trend, do you take the 0.5% over a long period of time, or do you take into account things which jump in value suddenly?
No, it's the maths behind it Rashpal is doing. He got the idea of regression from me. It's the rate of rise of the regression line as a percent per week. That you can do that any day you like, as long as it's up there. And it also, in the quintile system, it needs to be at the top of the list. I mean, we've often had, at the moment the Indian market's going up, but it isn't going up strong enough to be in the top box at the moment. So that doesn't matter. All you can back test is a system, and we back test the system. You're owning the top box. That's all you're owning. And it means you don't need to predict when it goes bearish, because at that point, inverse equities come up to the top. So, I learned this trick of never making a prediction from a guy at Wellington in Boston, a very senior technician. Many of you might know him. He just says, I never make a prediction. But this is what we're doing. You stick to what is you know, and you've back-tested what you know, what is its edge. The edge is pretty good. It won't be perfect. And you stick to it. Now, we did play with the numbers. Let's beat this. Let's go for 20%. And we've got the numbers that do that, but there is much greater volatility in the equity curve. And we've been told by the clients we don't want the volatility. 15 and 40 occasionally, but 15, we're happy with that. My pension will look just great if it does that. We don't want what the hedge funds will offer you, basically. Yeah.
Why doesn't your investment club?
Can you?
Yeah, sorry. Why doesn't your investment club use your newsletter?
Well, it's not my club. I'm just a member of it.
You could recommend your newsletter, right?
They love picking small little stocks with hot stories. This is it's a game, but they love it. I mean, they put big money into it, or some of the people there do, and when they're right, it's brilliant, you know. And when they're wrong, it's equally brilliant. And what I've noticed consistently with these clubs is the losers normally eclipse the big winners. Yeah.
But the quality of the claret stays
The quality
the same.
of the claret is good, yeah. For me, the club is for tiny money, and it's bloody good fun. And that's where I'm learning about these hots. I don't read about them myself. As it happens, though, you know I like gold. And when gold goes up, silver goes up more. And when silver is going up, Wheaton is a warrant on silver. So in the year when gold and silver do well, Wheaton flies. Incidentally, last year, the year I won, gold was up 12%. So if gold now does more than that, you could have Wheaton again for this year in the club. We wouldn't get into my model here, though.
Separating business and pleasure to an extent.
Yeah.
Any further questions?
Just a quick one. On your presentation, you showed the strongest sectors
Yeah.
in different currencies.
Yes. Some of the clients are American. They only think in dollars. We tend to think in pounds, and the Europeans in the euro. So, and basically, it's the same list of assets, but to an American, we'd give him a slightly different ETF to the ones we might buy. That's entirely down to Rashpal. Rashpal, believe it or not, has actually got a certificate. He's qualified in being an expert on ETFs. But the thing there is to make sure that the ETFs you're using to do this actually work. Because quite a lot of ETFs don't work. As long as you've satisfied my list are fine, you can do this easily. Yeah.
And does the performance vary much?
A little bit. It depends. I mean, when the dollar is overwhelmingly strong, it's pretty difficult to beat that. I mean, I have a very wealthy client whom we have very good lunches with, and he always tells me about his portfolio, all the lunches, and I just say to him, Alan, you should have liquidated your entire portfolio, put the lot into dollars and sat in the bank. You would have been much better off. And he goes, oh, well, I couldn't do that. You know, he wants the portfolio to do it. But that's real investment. It's not about that. You know, you shouldn't be stuck where your culture is stuck, really. This enables people to genuinely follow global asset markets by only really following 40 different instruments to do the trading. And trading actively enough, but not too active. Because if you over-tweak it, your expenses melt you back down again, as we know. Ours are sensitive enough, as I say, as a rough prediction, you'll hold most things for 3 months minimum and hardly ever more than 9 months. So that's right. You know it's about to change, but you shouldn't anticipate it. You wait till it makes you change.
And someone following your newsletter would basically do some work at the end of each month then? Is that what you're saying?
Well,
They rebalance
or
it.
what's happened in the last 3 months is they look at it, great, I've got the right things. Or they may have taken the top of India because of the wobble, basically. But if you were in a different currency, it's still up there, you see. So it does vary which currency you're in.
Okay, thank you.
Yes, sir.
Given the increase in passive investing, do you think is that more likely that your system, which effectively is a trend type system, is more likely to be working, keep working well in the future?
Yes, we've tried to work out when will we go wrong. And the crash is one. In 53 years, I've had one crash. If we have another one, we will take a hit. And the second one is the surprise. If I had to guess outright, 2010 would be a loss-making year, I wouldn't have guessed that. So what that happens is you get strong movements that look like trends, but they don't last long enough to really be trends. So if we were to go into a highly volatile period like that, and I guess we could make a scenario that would produce, well, then the system would stop working. But what might happen is the rate of rise of the strongest trends might fall to be less than 0.5%, in which case you're just out. You're back into your base currency at that point.
Any further questions? Well, I think it's fair to say that whatever markets you follow and whatever methodology you use to do so, we can all learn something from each other, and particularly so from a long-standing expert like Robin. Thank you so much.